Wall Street's having the best day that it's had in several weeks after, of course, a disastrous month of May. Joining us here today to break it down for us, Michael Santoli, the author of the Streetwise column in Barron's each week. Michael, thanks very much for being with us. So, what's going on today? Why have we turned the page on what had been a dismal performance?
Yeah, I mean, clearly we came into the week with the pretty much stretched to the downside as far as you typically get. The rubber band was stretched pretty thin, mostly because bad news has been relentless, right? We go down 10% in approximately a month in the market in terms of the S&P 500, topped off by the jobs disappointment on Friday. Seems to me the cessation of negative news, I think, was enough really for at least a quick bounce. And what we have is a bounce. We're only back to levels of last Thursday's close, let's remember, even though we have a big rally on a one-day basis. So I think, to me, you've had 30 of the last 35 major economic releases been disappointments. That tends to manage expectations among investors pretty low, and I think that's where we are right now. So just a glimmer of a report today that the Fed might be looking to help sooner than later with more money thrown at the banking system maybe was enough to say we're not going to see the end of the world just too soon.
And in your column this past weekend in Barron, you made the argument that, even a little bit of good news, given the oversold conditions that we'd endured, that even a little bit of good news would be enough to kind of really propel this market higher. Yeah. Is it playing out pretty much as you sketched it?
Well, it's playing out in the sense of this bounce, this relief from that selling pressure that we've had for weeks right now. And I do think that, a lot of the risk in the market have been taken out, not just because the overall market was down 10%. Financial stocks had gotten crushed, and very deeply cyclical stocks, the ones most tuned to say Chinese economic expansion, had been really nailed pretty badly. So we were really kind of going along that script of 2011. Strong first quarter rally. All of a sudden we have simultaneous European debt fears flaring up. At the same time, China's slowing down, and we have a little bit of a growth scare in the U.S. So all of that, I think people had gathered up a lot of that fear. So yeah, it's playing out, but I think this is a bounce until proven otherwise.
And, is this bounce susceptible to just, a quick and immediate sell-off given, tomorrow we'll have Spain auctioning off some, some of its bonds. Not sure how that's going to go. We really don't have any clarity about exactly what's going on with QE3, but Ben Bernanke will be speaking tomorrow. So, does a recovery become immediately at risk if we don't get some follow-through in terms of constructive developments on those critical fronts?
I think there's a decent chance of that. I mean, basically, the swing factors are all in play this week that you would look toward to determine whether this is just going to be, a quick little bounce that, scares off the short sellers for a little while. I do think that there's two things going on. You had investors conditioned for the idea of a long, tough summer. European debt crisis is, no closer to a solution really in a wholesale basis than it was before. On the other hand, everyone remembers as soon as the central banks have something persuasive to do in terms of backstopping these economies, you get 30% rallies like we got from October to March of this year. So I do think people are nervous on both sides of it. You can't be too defensive if all of a sudden the cavalry is going to come and they're going to start printing money again. So that's why all these factors are going to determine exactly which way we go on this. I do think that the credit markets hold all the key. The stock market's really just been following along with what the credit markets have had to say, and that's going to continue.
And the credit market problem, coming from Europe and extending around the globe, it doesn't seem as though the ECB thinks that there's really a monetary solution to this problem right now. They'd rather see the politicians try to remedy this. If the ECB remains reticent about taking a role in redeeming these problems, does Europe remain intractable?
Well, or at least it remains in a position where people think it's intractable. And I think the big risk here, investor-wise, is that the history has been bureaucrats and policymakers and politicians really need the markets to throw a huge tantrum and make it seem like a clear and present danger of meltdown before you get decisive action. They're not preemptive. They're not built to be preemptive. And so I think that's what we saw in 2011. And, we can even go back to 2008 when we had the TARP vote in the United States. They voted it down the first time. Dow goes down 700 points in a day. Guess what? We vote for it now. That's the kind of thing I think you have to be concerned about if people delay longer. The markets are not patient. The markets don't wait for these processes to play out in a measured way.